the war that wasn't fought with guns. It began with silence, an unsettling calm that had a clash more consequential than any battle waged on a field. No armies assembled, no cannons fired, yet the struggle that unfolded threatened to reshape the nation just as profoundly as any war in its history. It was a conflict over money, power, and invisible forces that guided the country's future. To understand why this silent war still matters, we must return to a moment when America's financial system stood at a crossroads. The nation was expanding rapidly, stretching its economic muscles across new territories and promising opportunities. But beneath that promise lay tension: the government and the banking sector. Two pillars meant to support the country had grown wary of each other. Their interests overlapped, collided, and eventually clashed in ways that neither side anticipated. At the heart of the conflict was control. Who held the real authority over the nation's money supply? The government, elected by the people, or the banks, trusted to manage the flow of credit and maintain financial stability? Each side believed it had the rightful claim. Each feared the consequences of surrendering ground, and each was convinced the other posed a threat to the nation's future. The first signs of strain appeared quietly: a policy directive that limited lending, a change in interest rates that favored one region over another, a sudden shift in government spending that pressured banks already operating on thin reserves. None of these events on their own looked like acts of aggression, but taken together, they formed a pattern, one that signaled the beginning of a power struggle hiding behind polite speeches and carefully worded letters. Bankers felt the pressure immediately. They recognized that the government's new direction, subtle though it was, threatened their autonomy. Officials insisted the changes were necessary to protect the nation. Bank leaders whispered that the government was tightening its grip. Suspicion grew on both sides, quiet but tightening like a rope pulled from both ends. Meanwhile, the public remained unaware of the battle unfolding above them. Merchants continued their trade. Laborers went to work. Families saved what they could. But behind the scenes, decisions were being made that would eventually shape every loan, every paycheck, and every piece of currency in circulation. The early beats of the conflict formed with remarkable subtlety. Policy hardened. Banking practices shifted. Tension spread under the surface, invisible but unmistakable to those close enough to feel its weight. The players weren't soldiers, but they were preparing for a confrontation all the same. And though no shots would be fired, the consequences of this quiet war would ripple across the nation, leaving a mark deeper than any battlefield could carve. The tension deepened as each side maneuvered for advantage, their moves measured, deliberate, and cloaked in a language of policy rather than conflict. But beneath the polished speeches and formal letters, the struggle had evolved into something undeniable: a war for control over the financial soul of the nation. The government made the next move. New regulations appeared, carefully phrased, seemingly modest, but unmistakably aimed at tightening oversight. Limits on credit expansion, restrictions on certain banking practices, reporting requirements that, for the first time, forced institutions to reveal uncomfortable details about their reserves and risk exposure. Officials argued these rules were necessary safeguards, but bankers saw something else: encroachment. Their response was quiet but fierce. Banks tightened lending, cutting off credit to industries already stretched thin. They framed it as responsible caution, a necessary adjustment to the new regulatory environment. But the timing told another story. By restricting loans, they signaled to the government that they still held leverage over the economy's heartbeat. If pressed too hard, they could slow the nation's growth, something no elected official wanted on their hands. The public began to feel the strain. Merchants found previously routine loans delayed or denied. Small businesses hesitated to expand. Farmers faced higher borrowing costs as banks recalibrated their risk models. Newspapers noted the shifts but framed them as economic fluctuations, not symptoms of a deeper conflict. Only a few observers sensed the truth. Two of the nation's most powerful forces were engaged in a test of strength. Behind closed doors, the tone sharpened. Government advisors warned that the banks were becoming defiant, using credit as a weapon. Bank presidents claimed the government was attempting to nationalize financial authority through incremental restrictions. Letters circulated between policymakers describing uncooperative institutions and potential threats to stability. In boardrooms, executives discussed strategies for resisting regulatory pressure without provoking open confrontation. Each side watched the other anxiously. Politicians wondered whether tightening rules further would ignite backlash. Bankers debated how far they could push their quiet resistance before public opinion turned against them. The air was thick with suspicion. Every policy shift felt like an attack. Every financial contraction felt like retaliation. The emotional tension grew as uncertainty spread across the country. Workers worried about wages. Businesses feared stagnation. The sense that something invisible was pulling the economy's strings began to seep into public consciousness. People felt the effects long before they understood the cause. What made this conflict so dangerous was its silence. There were no speeches declaring war, no rallies in the streets, no dramatic announcements. Just two titans, government and banking, pushing, pulling, and testing each other's resolve. And with every move they made, the pressure increased. The early conflict had evolved into a simmering standoff, and both sides knew the next escalation would bring consequences neither could fully control. The conflict could no longer hide behind polite language. What began as subtle tension had become a struggle that radiated through every corridor of power. The government tightened policy again, new measures designed to curb what officials called excessive financial influence. Bankers didn't hear caution. They heard confrontation. And their response made the nation feel the strain. Credit contracted sharply, not gradually, not symbolically, but decisively. Businesses that had survived on predictable loans found the doors of finance closed to them. Manufacturers slowed production. Shipping companies postponed routes. Farmers who depended on seasonal borrowing stared at fields they suddenly couldn't afford to harvest. It wasn't a strike. It wasn't sabotage. But to the government, it felt dangerously close. Behind closed doors, tempers flared. Advisors warned the president that the banks were weaponizing their influence. Political allies urged stronger action, arguing that surrendering to financial pressure would hand institutions unchecked power. Letters circulated describing coordinated resistance, quiet retaliation, and economic coercion. The war no longer lurked beneath the surface. It was shaping policy, shaping markets, shaping lives. Inside the banks, boardrooms pulsed with anxiety. Some executives feared the government's next move, worrying that additional regulations or investigations could cripple their institutions. Others urged a harder stance, arguing that giving in would set a precedent for government dominance. It became a battle between fear and defiance, each decision heavy with consequence. Meanwhile, the public felt the emotional toll. Workers lost overtime hours. Small businesses struggled to pay suppliers. Families heard whispers that the economy was tightening, though no one seemed to know exactly why. Newspapers tried to explain the downturn, but danced around the truth. Few wanted to suggest that the nation's financial stability was caught in a silent tug-of-war between two powerful forces. Markets grew erratic. Investors interpreted every speech, every policy shift, every rumor as a signal of what might come next. A slight drop in gold reserves caused panic selling. A government report triggered a brief rally before anxiety returned. Confidence, the invisible glue holding the system together, began to crack. Then came the moment that pushed the conflict to its emotional peak. A well-known merchant association released a public statement blaming the government for the economic slowdown. Hours later, a coalition of bankers issued a counterstatement accusing federal policymakers of reckless overreach. The dueling proclamations ignited public outrage. Citizens demanded answers. Politicians pointed fingers. Editorials framed the conflict as a battle for the nation's future. The truth was simpler and far more troubling. Neither side could back down without losing authority, and both knew that the next step could trigger consequences far greater than either had intended. The buildup was now unmistakable. The silent war had reached the edge of open confrontation, and the nation stood trapped between two forces, waiting for the blow that would finally break the stalemate. The breaking point came with a decision that struck the financial world like a lightning bolt. After months of tightening policy, deepening suspicion, and a silent standoff that strained every corner of the economy, the government made its boldest move yet. It enacted a sweeping reform that redefined the balance of power, stripping banks of the authority they had long guarded and placing new controls directly in the hands of federal regulators. The reaction was instant. Markets trembled. Bank executives issued furious statements. Some predicted economic collapse. Others called the reform an attack on free enterprise. But beneath the outrage lay something deeper, a recognition that the government had won the confrontation. The silent war had ended not with compromise, but with decisive action. Inside the banking halls, a heavy quiet settled. The strategies, the resistance, the quiet demonstrations of strength, all had failed to prevent what many feared most, a permanent shift in financial authority. Institutions that once dictated the nation's economic rhythm now found themselves constrained, monitored, and reshaped under a new regulatory framework. It was not defeat in the traditional sense, but transformation, swift, sweeping, and irreversible. On the government side, the mood was equally complex. Victory did not bring celebration. Policymakers understood the gravity of what they had done. They had confronted powerful institutions and changed the structure of the economy, knowing the consequences would ripple for years. The choice had been bold, necessary, and perilous, and now they had to manage the fallout. The climax of this conflict revealed an uncomfortable truth. A financial system cannot be guided by two competing centers of power indefinitely. Eventually, one must yield, and when the balance breaks, the results reshape everything, from laws to markets to the lives of ordinary citizens. In the aftermath, the nation began to recover. Credit slowly reopened, markets steadied, businesses adapted to the new rules. Some people argued the government had saved the economy from dominance by private interests. Others insisted the reform was an overreach that would stifle growth. But regardless of opinion, everyone recognized that the era of quiet, unchecked banking power had ended. The resolution brought with it a quiet lesson, one forged in the tension between two titans. Stability requires clarity. A nation cannot prosper when its financial future is held hostage by an invisible war. And although the reform came with controversy, it also came with structure, the kind that allowed the country to move forward rather than remain trapped in conflict. Sometimes the smallest shift in perspective becomes the beginning of a new future.